Hey folks, Andrew Packer here. Welcome to Trading Tips. Continuing our video chart series pattern, I want to start with a little bit of a scenario that's happened to all of us from time to time. We all have that one trade where we put in the research and we put in the money and everything starts to go well and everything keeps going well. And the trade that we thought would give us maybe 20% in a year or 50% in a year or 100% in a year is suddenly giving us multiples of that. If anything, it feels like it's going too well. Almost suspiciously too well. Now, I don't know about you, but sometimes when I see a trade like that that's going incredibly well, I kind of start to worry that, hey, this big gain that's been going on, it's going to be given up at any point. I should be getting out as soon as I can. And we've all been there, and we all kind of kick ourselves later when we sell out of a position that's made a huge ton of profits, and then it keeps going even higher. But the fact of the matter is, using a chart pattern called consolidation, we can take a look and see what happens after a stock has a big run-up and is just pausing and refreshing before it moves higher. Now, these patterns occur in a few different types of ways, but the most common one is one called the rectangle pattern. So it's when you have something that's gone up, it's pulled back a bit, it's gone back up, it's pulled back down, it's gone back up, it's pulled back down. If you sort of look at these trends over time, this is where you get the rectangle pattern. And what's really happening is, at this earlier stage, money was pouring in, people were incredibly bullish, it was incredibly undervalued, and now it's sort of gotten fairly valued, it's run a little bit ahead of itself, and now there's really sort of no direction. And a lot of traders hate these kinds of things, especially professional traders, because they're looking for the really big swings. But as smaller investors, we actually have a huge advantage with these types of positions. And that's because you can have stocks that trade in these ranges for potentially months or even years at a time. For example, I know companies like Disney, J.M. Smucker Company, just off the top of my head, that will trade in ranges that are pretty broad and play out over a series of a few months. So if you buy on the low end, you can sell on the high end. Or if you own shares and you want to keep holding them, you can sell covered calls when you get kind of near the high point with a very high expectation that because of the next pullback, you're likely to keep the shares and get even more money out of the trade than you would have otherwise. So I actually like it when there's this sort of range-bound pattern that you see, although not a lot of traders do. Now, there are a few other types of patterns that indicate that there's going to be a consolidation after a big move has happened. One of the most interesting ones is called the falling wedge. And what happens is you have this big move up, then you have the pullback, then you have a rally again that's not quite as high, and you have sort of another pullback, and sort of so on and so on. And this isn't quite the same as some of the reversal patterns that we've seen in other videos, but it is a situation where there is a bit of a downtrend both here and here, where you're setting lower highs each time you rally, but you're also sort of setting gradually lower and lower lows, and eventually the wedge pattern narrows and narrows and narrows. So like a coiling spring, eventually this sort of almost pressure builds up in the market because people are wondering hey, do I get bullish or bearish? And that's usually when you start getting the next move upwards. Because what usually matters with these continuation patterns is what was happening before we got into this type of situation. There's a final chart pattern that's somewhat similar to the wedge, and honestly, they look pretty similar to me, 9 times out of 10, and it's called the pennant pattern, and it's essentially going to look about the same. It's the idea that there's a little bit more of like a sort of a flag when you take the two different trend lines of the tops and bottoms of this sideways continuation trade and watch it move higher. Now, as with all of the chart patterns that we've seen, this actually works in the other way as well. So when things are being bearish and when things are going down, we'll get that similar rectangle pattern that indicates, hey, people have sold off and now people are wondering, hey, is it okay to get back in yet? And you might be wondering as a trader and investor, is it time to get back in? And the fact that it's not making new lows, might lull you into a false sense of security. So this is one to watch out for on the downside. If you have a position that's fallen on you and it's sort of been bouncing up and down and trading in this range, you might be better off just, taking your loss on that or, taking profits if you do have profits on it and just getting out of that trade, because chances are once this continuation pattern is completed, it's going to resume its downward path. And you have the same situation with our, pennant pattern and with our wedge pattern that we have here. So by looking at these patterns, one of the key takeaways is the fact that everyone just thinks, oh, the market just goes up or it just goes down. That's not entirely true. The market actually has a lot of these patterns going on at a given time because the entire market can trade sideways. Individual stocks that have had a big run up or big run down can trade sideways for a very long period of time. And you can get some short-term profits again and again by taking advantage of some of these moves, but also just bear in mind that at some point, whatever pattern was occurring before is likely to resume at the end. And if you get to the end of this pattern and a different type of pattern forms, like one of our reversal patterns, like a head and shoulders, then suddenly what was going up is now going to likely start going down. So, but until you get that, the chances are the existing trend is going to continue. So this is when you're going to want to just follow closely. But if you're a stock investor, and you have months to play these little mini peaks and valleys in a position, that's a great way to get extra income out of a trade. If you're more of a short-term trader for like currencies or options, you probably want to avoid some of these trades because overall the lack of direction can be a bit more challenging. So that'll wrap up the part where we talk about our consolidation and continuation trends. Now obviously if you're more of a short-term trader and you start getting in one of these patterns, you might just want to get out and look for another opportunity elsewhere and something that's likely to have a bigger move rather than stick with something that's going to be trading in a narrow range for a while. So that will wrap things up for this edition of Trading Tips. I'm Andrew Packer, wishing you good trading and good financial health.